You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 1/18/22, and we've got the pleasure of having one of the world's leading economic historians with us now. His name is Bob Hoye. If you haven't heard him before, you should listen very closely. Bob, always great to have you on the show. So we're entering uncharted territory, or maybe it was charted in the 30s and we just forgot about it.
Hey, Kerry, it's wild. I could also say that the Federal Reserve and other central banks are probably the most aggressive they've ever been. And it has been a fantastic bubble, financial bubble, that in the last year has been accompanied by a really good boom in commodities. But the boom in commodities is interesting because it was a series of rotations where you had copper earlier in the year and a good run of crude oil, and then everything took a little rest. And then beginning, say, August, September, all of a sudden, boom, they started off into natural gas, aluminum, and then plus some of the exotics like vanadium. No, it's off its highs. But cobalt and lithium are making new highs. The meat sector, like beef, cattle, near new highs, and the pork section not. So while everybody is singing the song about commodities, it's been a selective and rotational type of market in commodities. So the way I've looked at it is that the rise in commodities is part of the increase in business activity that you get with the final stages of a financial mania. So, and I know that it's very popular now. The guys are looking at the Fed saying it's reckless, and you've got a Marxist administration, which is even more reckless, and that this time we're going to get 1970s inflation. And my case is I don't think so. The pattern for 300 years has been that you have a huge global boom in commodities and followed a decade later by a great bubble in financial assets. The first financial bubble was in South Sea bubble in England in 1720, and also in the same year, the Mississippi bubble in Paris. And that was a decade after the a global boom in commodities. And sometimes it's like 13 or 14 years. Sometimes it's 9 years. Because then there was another, like 1813 was, with the Napoleonic problems, was a high for commodities. And then you had a magnificent bubble that completed in 1825. And then, but now, here's what I'm getting to, is that the price gains for commodities such as wheat, well, that one was really good. There were two peaks in commodities, 2008 and 2011. And on that one, the gain in wheat as adjusted by the producer price index was the biggest in 120 years. And then similarly for copper, say, or zinc or aluminum, where you got the numbers, that one was, and again, adjusted by PPI, were the biggest gains, and those were 100-year charts. The wheat chart I was able to get was longer than the others. So the boom in 2008 and 2011 in commodities was, you can say, was the biggest percent gain in 100 years. And at the time, we used this to argue that the boom was blowing out, and that the rise, price rise, the real price rise, was so strong that it would increase capacity, mining capacity and manufacturing capacity in metals, for example, hugely, which it did. So anyways, so that one, I remain convinced, Kerry, that the big boom in commodities with the last one in 2011 was the setup for a great financial bubble about a decade later, which is around now. So let's just take a look at the financial side and see how extraordinary it has been. And it has been extraordinary with unprecedented financial events. One is that the 10-year note in Germany got down to almost minus 1% nominal. In all the history of interest rates, you've never had any instrument nominally trade at a minus level where you paid the guy to hold your money for you.
You pay to save, right? Makes sense. Makes total sense.
Now then the other one. Now, like the South Sea bubble, which I mentioned in 1720, a stock went from 100 pounds to 1,050 pounds, and then all the way back down to 100 pounds, all within a year and a half. So it was one of those ancient commodities you call a round trip. But that was the big cap stock, and the gain was, let's say, 10 times. And then with indexes and other things on the other bubbles, you can say that the big gains would be in the order of 10%. Now, you've got here the crypto and Bitcoin sector, which have huge capitalizations, and the percent gains are factors greater than 10 times. So those two things, German notes, 10-year notes at minus, never happened before. And the percent gains for big cap sectors have been extraordinary. Now, in previous bubbles, like 1873 or 1929, you could have a mining stock become a darling, in which case you go from pennies to maybe $10 or something like that. Well, those are those percent gains, but they're not in a large cap vehicle. So it's the numbers show that the percent gains in real commodity prices to 2011 were the biggest in 100 years. And then there's the two things I mentioned, negative yields and the Bitcoin sector, big gains that have never happened in big cap stocks before. So the party has been financial assets, highly overpriced, at times tremendous momentum and technical excesses and stuff like that. So this is where I think the financial markets are kind of hanging on a cliff, but you don't know how far the flat land's going to lie. It's going to be there. It's sort of like the road run, the coyote, Wile E. Coyote. He's on land at the moment, but he's not off the cliff yet and yet to discover it. So you just sort of watch for things. Now, here are some other facts about great financial bubbles, is where you can get the real copper price. Like we were able to get it back to 1825. In the final stage of a great financial mania, such as 1825, 1873, or 1929, copper's real price went up. And with this boom over last year, copper's real price went up as deflated by the CPI. So then here's the one that's confusing. Going the other way, in each, right back to 1720, gold's real price, as deflated by the consumer price index, goes down with the boom. I'm not going to explain why. It just happened. So then gold shares underperform the broad market, the general stocks. Okay, those are two items. Now, the price of copper did go up until, I think it was August, real price. And since then, it's sort of corrected. And gold's real price went down to 3 or 4 months ago, and it's come up a little. Nothing dramatic yet. So now there's another item, and that's real long interest rates in the senior currency. And and again, we've got these back to 1720. Real long interest rates in the senior currency, adjusted for inflation, go down. I guess the latest posting was December, and I think it was about minus 6%. Now, in the past, like the 1873 bubble and whatnot, you did get down to, if I can recall right, like a minus 7 or minus 8% real. Okay, so we've had that, and it looks like the nominal rate, that's the one you see trading day to day, is trying to go up. So real long rates have done what they've done in the final stages of a bubble. Now, if you want to jump over to China, where their index of junk yields last year was at 10%, and now it's over 25%. Just, you've had a huge markdown due to risk. And so that is a big and important economy, and real rates there had declined. Now they're going up. Now, and also, I did see one the other day about Japan and their government yields. They went down last year to minus 0.5%, and now they're at plus 1.5%. So in China, you've had junk rates decline real yield and have been increasing real yield, and you've got in Japan government rates that declined with the boom and are increasing. So these are common to every great financial bubble in history. So even the gold-silver ratio, in a boom, it goes down, and it did to last year. And then the gold-silver ratio since has gone up to about 82. I think it's close to breaking out. And that would signal a contraction. So, Kerry, what I'm going to sum up with is that you've got 4 key features of every great financial bubble, and all 4 have done what they do in a mania, and they've done it, and now we can't say that they reversed, but the action is perhaps changing. There's been, we can call it a modest correction. And what happens is when it gets dramatic is when the world discovers that there really is no liquidity out there. So, like in China, you've got the major property developers failing. I mean, this is a serious financial contraction. And then it's sort of selective, because here's one headline I got last week. Drop in land purchases signal cash woes for China developers. Bad news. Then on the same day, China venture funding hits record $311 billion despite crackdown. So part of China is in a severe contraction. There are parts of China that are still in the party mode. So it's a fascinating market, Kerry.
It certainly is that. Nobody can deny that. And it's it's the world's largest real estate market. And by both in size and in terms of value, I read that it's a $64 trillion market, which is about 50% higher than in the U.S. And in China, you don't have all the investment options that you have in the West. And the Chinese people I've met, many of them have invested in real estate in China because that's what the government tells them to do. It's amazing how many Chinese are not invested in precious metals, and you can see what's coming.
Don't just survive, thrive. The Financial Survival Network.
Trilogy Metals is a world-class developer in Alaska's Ambler Mining District. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yeah. Now, I had heard from a pretty good source that there's something like in China, 150 million empty apartment units, just sitting empty. Now, also with the big developer Evergrande that's been getting all the headlines for the last year, there's also animosity in various municipal governments. So if you're not bribed the right way, bad things happen. So Evergrande had developed a new island type of thing, shaped ground, and they built many apartment towers on it. And somehow the overriding municipality says, "Oh, this was fraudulent, not to be done." So they've got to tear down 39 apartment towers.
Wow.
I mean, it's crazy.
Yeah.
And then there are other examples where if the municipal officials are getting the right bribes, anything can happen. And so now all of a sudden this Evergrande, which is in serious distress, Evergrande is in serious distress. All of a sudden they've got to tear down 39 empty apartment towers. I mean, it's madness.
Hard to believe. Hard to believe that this could be taking place. Even as crazy as our judicial system is here in the U.S. and in Canada, they wouldn't make you knock down 39 fully completed high-rises. They might find the hell out of you and really, really hit you. But one of the things we want to look forward to is that when the financial speculation finally burns itself out, at each post-bubble contraction, as I mentioned, real price of copper and base metals go down. That frees up supply and labor for the gold sector. And it seems like irony, but what happens in the post-bubble contraction is that gold's real price goes up as adjusted for inflation. And the real price of gold going up reflects operating margins for gold mining. So the real price going up makes mining gold very profitable. And Kerry, it also helps, say, with geologists in valuing a gold prospect. You don't have to be in operation to benefit from a rising real price of gold. So so each post-bubble contraction the feature has been a long trend in the real price of gold going up and creating a fabulous bull market for gold miners. Now, for example, Homestake was the premier producer back in the day, and in 1929, because the cost, everything was going up, copper and wages for mining, base metals and all that sort of stuff, and gold was fixed at $20.67 an ounce. The real price went down, and the gold stocks underperformed the S&P. As a matter of fact, I have to double check it, but I think that Homestake reported a loss in 1929. And by that, of course, they kept mining because, the mine was so good that then in 1930, with the contraction, gold's real price started turning up. But nominally it was still at $20.67 an ounce. And it stayed at that fixed price until March 1933, when Roosevelt started fooling around with the price of gold. So if you take then to year-end 1932, Homestake stock was up something like 135% when the Dow Industrials had suffered a crash. And then also on my memory, Kerry, is that you could have bought Homestake for $9 in 1930 and 31. And then by the end of 1932, I said it was up 130% in that order. And also their earnings were up that much. So then
When Roosevelt then raised the price, the party became even more fun. And Homestake stock, which could have been bought over a year or more at $9, got up to something like $65. Now, also within this, at the time, gold producers in Canada and the U.S., it was the way it worked is that they paid out everything by way of dividend. Everything that came in was paid out cash dividends. So in the mid-1930s, Homestake was paying $4.50 a share dividend, and on a $9 purchase. I mean, that's making money. Yeah. So then, so you of course you got I have the old charts on Homestake, and you know how it moved from say the $9 level to the 64, 65 level. And then you also had Dome Mines in Canada, another premier producer. Now, they had come up with a new ore reserve, so their stock really flew. But I also understand that it was an outstanding market for junior exploration stocks out of Montreal in those days, and some degree in Toronto, and also back in the 1930s, the Vancouver market would have been creating and trading junior gold. So what we're looking for is once it turns and gold's real price heads up. Now, to get gold's real price to go up more needs a financial contraction. So that's not going to be friendly to the gold stocks. It's ironical. But so anyways, we're watching for the next buy point technically on gold stocks. And from that will follow a multi-year bull market for the sector. And not just a bull market for gold stocks, but quite likely they will outperform the S&P. Now, that's what we called for. There was a nice a technical low for us in November of 2018. And then the next high was exuberant, July 2020. And we noted the technical excesses and advised people to take some money off the table. But at any rate, on that one, on the buy in 2018, it was with the advice that the gold stocks could outperform S&P. So if you take the GDXJ and the S&P, GDXJ was up by 2.2 times the gain in the S&P. So this is the prospect, Kerry, is that not just that gold stocks go up for a few years, but that they outperform the S&P. So now what happens if you're a fund manager who normally wouldn't position gold stocks? And then quarter after quarter, you're watching the gold stock index outperform your S&P. What do they got to do? They got to buy gold stocks at some point. So this is where a multi-year and very good bull market for most gold stocks, from big ones to exploration stocks, is ahead of us. And I think it'll be a lot of fun.
Sounds like fun to me. And hey, we've been waiting for a decade for this to happen here, Bob.
Yeah.
And,
well, the last big real high for gold prices was 2011 with gold and silver were way up there, highly speculative. And, the speculative excesses were notable. The one thing we use in the gold sector for speculative excesses, Kerry, is the silver gold ratio, because in a bull market for gold and silver always outperforms. So I think it was April 2011, the silver gold ratio, the weekly RSI got up to 90. And the only other time that RSI got that high was in January 1980, which was the top of that mania. So that was the technical tool we used to call for the market reversal in 2011. And actually in the crisis, 2020, that silver gold ratio it got to the exact opposite of where it was in 2011. So, but anyways, I think we have the ability. I think the research, let's put it this way, Kerry, the research on previous financial bubbles builds us a very good case for a multi-year bull market in gold. And then technically, with our technical stuff, we will probably be able to catch the next buy on the sector, and we'll be, of course, watching it. So this is where the most calculable opportunity will be. Now, there could be some new tech things come out, but you can't forecast those ahead of time. But the only thing that has been reliable is that once the great financial mania is over, then you go into a multi-year bull market for gold. So it won't happen. It's happened before, and it can happen again.
Yeah, and it probably will happen, no doubt. As Mark Twain said, history doesn't always repeat itself, but it certainly rhymes, and it's rhyming here. Any idea how high the gold price can get, do you think?
This historical research covers long periods of time when the senior currency was on a gold standard, like in England through the 1800s. So you work with the real price adjusted for inflation. And on 3 of the post-bubble periods, and in England, and when the price was fixed, the increase in the real price, you're not going to believe this, was 1.69 times. Well, let's call it 1.7.
Really?
That's on annual averages. And on 3 out of 4 of the post-bubble contractions, the price increase was, in round numbers, 1.7 times over something like 20 years. Now, also with that, of course, you've got, there are sources for annual gold production. So in one of those contractions, the increase in annual gold consumption or production with the higher prices was something like a double. And then on another one, the same price increase, you had, and that was to the 1845 depression bottom, which was followed by the discovery of gold in California, also at Melbourne in Australia. You had something like a 10 times increase in gold production. But the price increase on each post-bubble contraction was virtually the same. So that's on annual averages. So my estimate, then, a casual one, is that, let's say on monthly prices, gold's real price will likely double from what the low was a while ago.
All right, we're going to hold you to it. We're going to hold you to it, Bob.
You can, but Kerry, this will work even if the U.S. goes on to a gold standard. The same thing happens. So if you, that's the most rational way to come up with a price target for gold. It's probable that the U.S. with a major political reform, which I think is underway and will happen. And part of the reform will be the only way you can constrain the idiocy at a central bank is to go to a gold standard. And I believe that will happen. So here's my balls to the wall. The real price of gold from its recent low and over a period of years at times it'll accomplish a double. And the gold mining sector will be party time.
All right, Bob. Well, I have to tell you, if what you're saying is true about political reformation here in the United States, then I am going to go into a new venture. I am going to manufacture guillotines. You think they'll be in demand? You think they'll go up faster in value than gold?
Well, I'm telling you, those on the wrong side of the political equation are going to suffer considerable remorse and loss of structure. And
we can only hope.
Kerry, I've called it.
Yeah,
there's 2 bubbles out there.
I know.
One is the financial bubble. The other is the political bubble.
The stupidity bubble, I would say.
Yeah, sure. But the Democrats are doing things that are absolutely insane. Mm-hmm. And of course, at the top end of the financial markets, speculators are also absolutely insane. And I'm just a guess on this one. I think I think they'll both roll over at the same time. It's going to be one of those tidal changes, you know?
Yeah. Well, it's...
and I'm making headlines already for an article on the failure of the political bubble.
Yeah.
And it looks like Biden and the Democrats have run into a brick wall.
Yeah, and the Republicans aren't much better. We have to express that the corruption.
It'd have to have a special place in hell for rhinos.
Yeah, well, I've figured out why governments have not taken any action other than in China, and there it's been tepid at best, to rein in cryptocurrencies. Bob, you know why? I'll tell you why. Because cryptocurrencies are the best form of political bribery ever. They're instantaneous.
Oh, okay.
They're liquid. They can easily be
invisible.
Obscured. Yeah, not transparent. And I think you show me a politician, I'll show you a person that's got a digital wallet. Bob. Yeah, no, I had not thought of that, and it's good because I know my experience in Canada. The corruption in the province of Quebec is amazing, and I knew some people had a large manufacturing business they had a good plant in Quebec. And the way it works in Quebec is that the key bureaucrats retire to a free condominium in Florida. Oh,
so that's nice. How they were getting bribed.
Yeah, I know one's in New York.
Now, but your mention of using Bitcoin for... yes, I agree. I hadn't, my suspicious mind hadn't got there yet, but I'm with you on that, Kerry.
Well, there's no other explanation because eventually cryptos are a threat to central banks and the currency that they issue.
Yeah.
And the only explanation why they haven't stopped is because they don't really recognize the threat, and they're lining their pockets with cryptos. I mean.
Yeah. But, you got to also look at cryptos, the huge electrical energy costs to create them.
Yes, true.
And the huge electrical energy costs to keep them going. Mm-hmm. And I know decades ago you could create stock on the Vancouver Stock Exchange for 12.5 cents a share.
Yeah.
And then other than trust company costs, which was next to nothing, I know I did. One time, we did a stock issue at 25 cents a share, which at that time was considered high. Declared we had a discovery, and I halted trading on the stock for the winter because it was this northern exploration play, and split the stock 2 for 1. So all the original investors ended up with 12.5 cent stock, and it went to $7.
All right, I'd like to hear that. Well, you see,
so anyways. This is where I'm impressed with. I don't know what it costs now to create stock on the Vancouver Stock Exchange, but the cost to create an equivalent trading item, let's call it a counter, with Bitcoin is immense, and it never ends.
Yes. And what's great is, they have these things called smart contracts in the crypto world. I am creating the smart bribe. Okay.
Smart
bribe is really where it's at. Forget about smart contracts.
Oh, I love that.
All right. So it's gonna really revolutionize political corruption and really bring it up to the 21st century because it's been lagging.
Yeah. Yeah. No, I'm with you on that one, Kerry. I love the story.
Yeah.
I hate the evil.
Yeah. Well,
but I love your conclusions. So.
Yeah. Yeah, well, I hate to be a cynic here, but it's entertaining. So that's the important thing. Entertainment value trumps everything else.
Yeah.
Otherwise, why would we have had Donald Trump? But that's a story for another day. So, Bob,
it is indeed.
Bob,
good to chat.
Bob, so the future is bleak, but we just don't know how bleak it's going to get when it actually happens, huh?
That's on low-grade bonds, commodities, and stocks. But the future for the gold sector is, once it turns, is very good.
Okay. All right. Hey, Bob, so we just have to basically Google you. All your work comes up, everything else.
Yeah, just Bob Hoye, it just comes up, the whole thing. So,
all right. And have you got
charts and markets,
Great. And if you got a question for Bob, just shoot me an email to kl@kerrylutz.com.
Yeah.
And I will make sure you get an answer. Bob, always a pleasure, always enlightening. I love the historical perspective, because the one thing we know is that markets might change, countries might change, but people never change. And that's why you got to look at this history to really get a firm grasp. So like I said, just shoot me an email, kl@kerrylutz.com. Bob, we'll talk to you again real soon.
Very good, Kerry. Have a good one. Bye-bye.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.